But let's focus on HDFC and the case for a chat with them here being an outlook on housing finance. The board has approved a preferential allotment to HDFC. Let's try and also analyze the impact of MCLR hike and of course the accounting standard changes as well, which have taken place. So let's bring on board the Vice Chairman and CEO at HDFC, Keki Mistry, joining us on the show right now. Keki, on the onset, good morning firstly, and thank you so much. We at ET Now are celebrating our 9th anniversary week, and it gives us great pleasure that you could take time out and join us.
Well, first of all, let me congratulate you on your 9th anniversary. I think it's a great feeling to cross so many years and so many years of success. So congratulations to you.
Thank you so much, Keki, and you really have been an integral part of this 9-year journey. But let's talk about HDFC. Your AUM growth, Keki, has been between 15 to 18% for the last 3 years. Can we see you up this level, a better than 18% AUM growth and better than 21% loan growth? Is that what we can expect in the next fiscal?
I don't know what you can expect. I mean, I don't want to talk about what's going to happen this year or next year or the year after, but all I can say is that the structural demand for housing in India will always remain strong. And it is one of those sectors which is poised for growth, which will continue to grow with a long-term view. So if you look at the next 5 years, 10 years, even 15 years, my sense is that the demand for housing in India will continue to grow unabated. And there are several reasons for that, and we talked about that in the past, but just at the cost of repeating myself, firstly, housing has become probably more affordable today than ever before. Secondly, penetration level of mortgages in India is extremely low at 10% of GDP. Thirdly, the government's had this huge focus, massive focus on encouraging more people to buy houses, encouraging more developers to construct affordable housing units. And that is reflected both in fiscal benefits as well as in the CLSS, the subsidy scheme. And then last but not the least is the fact that India has a young population. 2/3 of our population is below 35 years of age. And unlike the West, in India, people buy a house only when they are in the late 30s. So the average age of a first-time home buyer in India is about 37 to 38 years. And with 2/3 of the population being below 35 years, what it really means is that over the next 1, 3, 5, 7, 10, 15, 20 years, all these younger people will get to an age where they will necessarily have to buy a house and therefore necessarily will have to take a loan. So structural demand for housing in India will always remain strong with a long-term view.
Right, Mr. Mistry, it's great that you say that. I just want you to kind of break a myth, because a large part of the line of questioning that we follow with regards to the demand for loans right now is how you peg that and what's the correlation with rising rates impacting that demand trend. Do you see that there's a disconnect there? Yes, at some point in time, the price of a loan will pinch the borrower, but it doesn't really have to be a one-on-one correlation.
See, what you got to understand is that for a person buying a house, a 0.25% increase or decrease in interest rates is really not going to impact his decision on whether to buy a house or not. What is most important from a customer's perspective is confidence. If he's confident of holding his job, if he's confident of the environment, there is a feel-good factor which is there, he will come and buy a house irrespective of whether the interest rate is 8.25% or 8.5% or 8.75% or for that matter theoretically even 9%. So customers don't look at interest rates that closely. At the end of the day, you need to understand that there are fiscal benefits associated with taking a housing loan. So the interest you pay on a housing loan is tax deductible every year to the extent of 2 lakhs of rupees. The principal repayment of a housing loan is considered as a saving, and along with other avenues of saving qualifies for a deduction of up to 1,50,000 rupees. So theoretically, if interest rates go up even by a 0.25%, the actual cost to a middle income home buyer does not go up by a 0.25%. It probably goes up by 15 or 16 or 17 basis points depending on how his taxes are structured. So therefore, interest rates don't make that much of a difference.
And that's heartening to hear. What about HDFC's own expansion plans, Mr. Mistry? I know you've been asked this question several times. Competition is building in the sector. There's a struggle to enhance market share. But on the flip side, you also, see housing as an underpenetrated sector just as yet. So, more and more Indians, like you said, would want to would want to own a house and would want to be part of the growth story when it comes to the housing space. Give us your own sense on how do you see HDFC expanding with regards to gaining more market share at a time when competition is really being aggressive. Is the path going forward one of acquisitions, inorganic growth, which will help boost your own revenues?
Well, first of all, we are open to any kind of inorganic growth if it makes sense from a valuation perspective and if there is some synergy that is, that we can get by looking at any particular company. We did look at Canfin Homes a few months ago, but that did not work out for whatever reason. And as you know, Canfin has not been sold. So we could look at inorganic growth, but more importantly, we have to look at organic growth. And my sense is that the organic growth will continue to remain strong because of the various factors which I talked about. You mentioned competition, but I just remind you of the fact that whilst we grew our our AUM by 18% for the year ended March 18, the sector as a whole grew at a much lower pace. So in reality, we would have gained a little bit of market share. But we have consistently told our investors over the years that we don't really pitch for market share. We have 4 objectives that we have targeted very closely over the years. One is asset quality. The other is operational efficiency, which is reflected in an extremely low cost income ratio. The third is growth at a pace that we target for ourselves. So these are the 3 or 4, and the fourth, of course, is profitability, which is reflected in profit margins, interest, income, and so on and so forth. So these are the 4 factors we look at, and we don't really chase market share. But having said that, as you would see in the last year, we have gained a little bit of market share because our growth was 18%, which is higher than the industry growth, which numbers are available from the RBI data.
Mr. Mistry, what's really happening with real estate as a segment? Considering you've got your ear closest to the ground, are we really seeing that revival in both commercial as well as residential real estate markets? Are all the demons of demonetization, the GST adjustment, as well as RERA really behind us? Are things beginning to look up in the real sense?
Well, my sense, first of all, the commercial real estate market has remained strong for a while now. So it's not been the last 3 or 6 months, but it's been well over the last 1 year that the commercial real estate market has remained strong. Residential, we need to understand that India is a very large country. And within that country, there are pockets in the country where the growth is strong, and there are pockets in the country where the growth is not so strong. So if you look at Mumbai, you look at Gujarat, you look at some of the places in central India, you look at some of the places in South India, if you look at Bangalore, the growth has remained extremely strong. So there are certain cities which are vibrant, which are growing very rapidly, and there are also other places where there is oversupply and therefore the growth is a little slower. So it is very area specific, and it's difficult to sort of pin it down to put a sort of all India view and say that the growth is very robust or not robust. But I would say the growth on an all India basis is reasonably robust, with certain areas being extremely strong.
So, Mistry, I'm going to come back to that point of inorganic growth, primarily because it just struck me that if you're either ways growing at a significant margin to the average industry, as you pointed out, the growth was about 18%. What would an acquisition do to your overall growth number, especially if it comes at a high price? I mean, you spoke about Canfin Homes, and I know that valuations are a concern when it comes to the housing finance sector. Why would you then even look at that route?
No, we would look at that route only if it makes sense from an ROE perspective, not if it does not make sense. So only if there is a synergy, and if it makes sense from an ROE perspective, could we look at organic growth or at inorganic growth. Otherwise, our target all these years has been organic growth. If you go back to the last 40 odd years of HDFC, you'd see that we have really looked at only two occasions when we've had inorganic growth. One was in both of them were in the early 2000s. I think it was in the year 2000 itself. One was when we increased our stake in Group Finance, and the other was when we bought over a East India based housing finance company. So these were the only 2 inorganic growth that we had sort of targeted. Otherwise, our growth over the years has always been organic. We target our return on equity very, very closely. We are very serious about our return on equity, and if with the valuations in the market being what they are, if it leads to a dilution in return on equity, then it does not make sense to look at any kind of acquisition.
Okay, let me ask you something very specific that's in the market's mind right now. Analysts are pegging core operating profit estimates to see a 20% compounded annual growth over the course of the next 5 years. Is that a fair estimate? Is that the kind of earnings drive that you would see?
We don't make comments on profit growth or on future growth, so I'm sorry I won't be able to answer that question. But you have to look back at the last 5 years and get a sense of what kind of growth we would see. We're also moving into a new accounting standard. So how the new accounting standard pans out is also something which would impact the profitability.
In a negative way, you mean?
No, I'm not saying in a negative or in a positive way. I'm just saying that there's a new accounting standard which is prevalent now. We are still not very clear on whether there will be any regulatory override on that standard. But per se, HDFC's asset quality historically has been very good. And because the asset quality over the years has been very good, under a pure Ind AS method of accounting, there would be a lesser proportion of non-performing loans that we would have compared to what we would have had under the original Indian standards. So there are several positives of the new accounting standards. There are obviously also a couple of negatives of the new accounting standards. So one has to wait and see how these balance out. But at this moment, we are awaiting regulatory guidance on a few matters which are in discussion with the regulators on.
Fair point. Keki, such a pleasure having you today on the show, and glad that you could take time out.